Welcome to Policy on Demand. I'm Stewart Brant. We're filming this episode at this year's International Tax Conference, and I'm pleased to be joined by Steve Kohart and Valerie Mulrooney to get into a deep dive on Pillar 2. Steve, Valerie, thanks for joining.
Great to be here.
Thanks a lot for having us.
Great, thanks. So Steve, there's been some recent OECD administrative guidance released back in December. It was predominantly focused on the transitional CBCR safe harbor and a pretty specific anti-arbitrage provision. Can you share some insights on this and what companies should know?
Sure, absolutely. So definitely a lot of interest in this December administrative guidance, around both, do I have qualified financial statements and, do I think I'm going to have a qualified CBCR report? We have guidance in this December package around how you account for purchase price accounting in the safe harbors. There are consistency rules around that might, add relevance to your 2023 CBCR report, where that would roll into your 24. In addition to that, very specific rules around how adjustments are taken into account that are made, perhaps after you finalize your consolidated financial statements. So more detail around, do I have qualified financial statements? Do I expect to have a qualified CBCR report? And then in addition, there are these hybrid arbitrage rules that came out in the December administrative guidance. And a lot of folks might quickly dismiss that and say, well, I didn't do any planning to get into the transitional CBCR safe harbors. I don't have a hybrid arbitrage arrangement. And unfortunately, it's not that simple because of the fact that these definitions are quite broad. They don't have a purpose test. So, we've been finding in practice that, many of our clients might not expect to have a hybrid arbitrage arrangement in their structure, but nevertheless, with the broadness of the drafting, some ordinary course transactions are caught. So there's a lot that our clients are thinking about as they work their way through the December administrative guidance, both around CBCR report qualification, and then also, am I potentially running afoul of any of these anti-arbitrage rules that were written into the transitional safe harbors with this guidance?
Oh, great, so a couple traps for the unwary. Valerie, on the technical front, there was also a U.S. notice 2023-80, released in December, addressing some of the Pillar 2 related questions. What are some of the highlights?
I think the specific highlights related to Pillar 2 are really around creditability of taxes. Like that notice obviously was extending some provisions around the application of the new proposed foreign tax credit rules that came in 2021, and this effectively extended that and specifically with respect to Pillar 2, they clarified the fact that like QDMTTs, as an example, are expected to be considered a covered tax and so creditable for U.S. tax purposes. But however, an IIR is not expected to be a creditable tax. And then the other piece of it was UTPR provisions. Obviously, we expect them to come in 2025, but don't really have detailed rules as to how they're going to, apply in practice. So the Treasury and the IRS have deferred kind of comment on that, but the expectation is that they would not be a creditable tax either. So I don't think there was anything unexpected in there. It was sort of what we expected to see. Obviously, this is just a notice, and we still need to see what the actual detailed regulations will say.
Great, so more to come. Valerie and Steve, I got a question for both of you. Switching gears here, what are companies seeing on the external audit front around Pillar 2 in terms of auditor requests and year-end disclosures for 2023 financials? Valerie?
I think it's been interesting. I would have like U.S. multinational clients versus inbound clients, and so they have different requirements. For 2023 year-end, I think a lot of it was just around disclosure statements. So, what do I expect the impact to be in 2024 versus, subsequent years? For U.S. multinationals, I think that the expectation, generally speaking, is probably minimal additional tax liability and impact in 24, with a bigger sort of impact in 2025, because a lot of those low tax entities are not sitting under an IIR jurisdiction. I think for the inbound companies, largely speaking, at least the ones I deal with, are European based, so they're subject to the full rules in 2024. So I think the audit of year end has been a bit more exhaustive, I would say, in terms of like actually making a real statement as to what the impact is expected to be. So for year end, I think it depended on your fact pattern. I think for Q1, it will be interesting. I think it will, depending on the size of an organization, complexity, I think auditors will kind of tailor their approach to it. And obviously Q1 versus Q2 versus Q3, I think there's a need for further refinement as we get through the quarters.
Yeah, and I would completely agree with that. There's definitely no one-size-fits-all approach. I think typically the approach is going to be matched to the company's footprint and I think that there's a lot more complexity now than we had before December, coming back to some of those points around the administrative guidance. And, if you're planning on relying on the safe harbors, not only getting your auditor comfortable with the computations that, I expect to, meet the requirements, but also the fact that I have good underlying data that I can use to meet those safe harbors. And then I've definitely seen some folks thinking about sensitivity testing around, okay, well, if for whatever reason I didn't have a qualified CBCR report and I had to do the full Pillar 2 calculation, am I in a place where I can do that? And what do I think the result would be?
Oh, great. So, Valerie and Steve, one key takeaway for companies to consider as we move forward in this Pillar 2 landscape?
I think, obviously the December admin guidance talked a lot about C/C or safe harbors, but some of those anti-arbitrage provisions, they obviously said that they intend on reopening the existing guidance to implement those rules into the broader GLOBE rules. So I think more to come on what that actually looks like. And I think as you do everything, we obviously think about what is the foreign tax impact, what is the US tax impact. I think now it's what is the Pillar 2 tax impact. So to the extent that you're doing restructurings, acquisitions, divestitures, everything is just that little bit more complicated, and I think there's unintended consequences. I think obviously certain jurisdictions we still haven't seen actual legislation, but the rules are actually in effect. So it's a little bit of a movable feast, and I guess keep watching, and things will continue to change.
Yeah, and I would say, that uncertainty and volatility are likely going to be the case for some time. The OECD's indicated they're going to continue issuing administrative guidance, and as Valerie just pointed out, the rules are live in many jurisdictions. So we'll need to see how those jurisdictions adopt the guidance, whether they can adopt it retroactively. And I think, the takeaway there is, even if you think you know your answer under Pillar 2 today, staying on top of the guidance that's coming out, because what we've seen, just with the December guidance, there were a lot of taxpayers who thought, well, I'm in great shape with the CBCR safe harbors and I expect to have a qualified CBCR report. And now we have all these new things to think about. So just because you think you have the answer, definitely makes sense to stay on top of the changing developments and how that impacts the legislation in the jurisdictions that are applying the rules in your structure.
Thanks, Steve. Thanks, Valerie. It's been a pleasure having you. Great insights, a lot to consider.
Yeah, I think, watch this space, more to come, definitely.
Thanks so much for having us.
Yeah, and thank you all for joining. It's been a pleasure. Take care.